Are you confused about the recently passed Big Beautiful Bill and what it means for you? Well, you're not alone. There's a lot to digest in the almost 900-page bill that was signed into law on July 4th. Of greatest concern seems to be the impact on Social Security income for retirees. So today, I'm going to break down the key measures affecting retirees and their families in this special bonus episode of The Retirement Fix, a podcast for less stress and more success in your go-go retirement years. Hi, I'm your host, John Gigliello, a certified financial planner with the Albany Financial Group, and I'm here to be your guide to keeping more of your hard-earned money by making smart financial decisions in retirement. Now, this podcast is for people nearing or in retirement who want to learn more about proactive tax planning, retirement income planning, Social Security timing, investment management, and asset protection. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. It's important to understand that the 2017 Tax Cuts and Jobs Act, or TCJA, passed during President Trump's first term, was scheduled to sunset at the end of this year, bringing back higher tax rates and lower estate tax exemptions, among other provisions. The so-called One Big Beautiful Bill Act, signed into law by President Trump on July 4th, creates an extension of the TCJA, making many of the tax cuts permanent while increasing spending for border security, defense, and energy production. The bill contains several controversial provisions and passed by razor-thin margins in both the House and the Senate. But today I want to try to avoid the politics and answer the most pressing question I get from clients. And that is, how will this affect my income, especially in retirement? Well, the biggest impact this bill has on retirement income is providing an additional senior exemption to help offset Social Security income. Proponents of the bill have been touting the measure as a way to make Social Security tax exempt, and the Social Security Administration estimated that nearly 90% of Social Security beneficiaries will no longer pay tax on their benefits. However, it's important to note that Social Security income is still taxable at the federal level and in some states. What the bill does is it provides a temporary personal exemption of up to $6,000 for seniors age 65 and older. The tax break is available to people with an adjusted gross income of $75,000 or less and $150,000 or less for couples filing jointly. The deduction phases out for people who earn above those amounts. Each spouse can take the exemption for a total of $12,000 if both are 65 or older. This tax break is temporary and set to expire at the end of the year 2028. This additional exemption, coupled with the standard deduction for seniors, may offset most, if not more, income than many seniors earn in Social Security benefits. As I mentioned, the bill made permanent, of course until someone comes along and makes it not permanent, many of the provisions of the 2017 bill, including setting the maximum tax rate at 37% and not allowing it to increase to 39.6% as it was set to do next year. Standard deductions on tax returns also remain at the higher level set in 2017, indexed annually for inflation. For 2025, the standard deduction is $15,750 for individuals and $31,500 for married people filing jointly. You can now also claim a deduction for charitable contributions up to $1,000 for single taxpayers and $2,000 for those married filing jointly, even if you do not itemize your deductions. Previously, taxpayers could only claim a deduction for a charitable contribution if they itemized deductions on their tax returns. Due to the higher standard deductions I just mentioned, very few people were able to itemize. The bill also permanently increases the estate and gift tax exemption to $15 million per person in 2026, and this amount will be indexed annually for inflation. This is an important consideration in estate planning, since a couple can effectively pass $30 million of wealth to future generations without an estate tax. However, pay close attention to your particular state's estate tax rules and exemptions. For those states that do apply a wealth tax or estate tax, in many instances, the exemption is much lower than what the federal amount is. For example, in New York State, the exemption per person is currently at $7,160,000. Now, this may not affect a lot of retirees, but it is interesting to note that the bill helps parents by increasing the child tax credit from $2,000 to $2,200. It was slated to be reduced to $1,000 per child at the end of this year. The bill also created a Trump account for all children born as U.S. citizens between the years 2025 and 2028, with a one-time deposit of $1,000 from the federal government. Now, there's still a lot to learn about these accounts, including how distributions will be taxed in the future. But what we do know is that these accounts will be a type of tax-advantaged savings account into which parents can contribute up to $5,000 a year. The accounts will be invested in a diversified fund that tracks a U.S. stock index. Employers could also contribute up to $2,500 to an employee's account, and it would not be counted as income to the recipient. Earnings grow tax deferred. Electric vehicles purchased after September 30th this year are no longer eligible for tax credits. The bill ends tax credits created under the 2022 Inflation Reduction Act for new and used electric vehicles, installation of home EV charging equipment, and insulation or energy-efficient heating and cooling systems. The bill, however, provides incentive for taxpayers to buy American-made automobiles. Through the year 2028, up to $10,000 in car loan interest is tax deductible for domestically produced cars. There are some eligibility restrictions, though. For example, the deduction's value would start to fall for individuals whose annual income exceeds $100,000. The threshold is $200,000 for married couples filing a joint tax return. Cars must be assembled in the United States. The 2017 TCJA limited the deduction that can be taken for state and local taxes to $10,000. The bill passed last week raises the cap to $40,000, indexed for inflation in each of the next 5 years. This deduction limit phases down for taxpayers earning $500,000 or more. This provision primarily affects people in high tax states like New York and California. If you itemize your deductions, you will now be able to deduct up to $40,000 of the taxes you pay for property, school, and state income tax. Much like the provision that allows a deduction for taxes paid or owed on Social Security income, the bill effectively does away with tax on tips and overtime pay. Tip and overtime workers will still pay taxes, but may be eligible for additional deductions when they file their taxes. Tip workers making less than $150,000 or $300,000 married filing jointly can deduct up to $25,000 for tips, but would still have to pay state, local, and payroll taxes on those tips. Workers putting in overtime and with the same $150,000 individual, $300,000 married income brackets would still pay taxes on the straight time, but may be eligible for up to $12,500 in a tax deduction for individuals and $25,000 married filing jointly on the 1/2 increment of pay. There are a lot of details with this provision, which are temporary, and they plan to run through the year 2028. So these are just a few of the highlights and the ones about which I've been receiving questions. If you have questions about this or any other financial planning topic, please don't hesitate to reach out. One of the services I offer high net worth retirees is proactive tax planning. We review anticipated income from all sources each year and employ strategies to help clients make the most of their hard-earned money. If this sounds like something from which you could benefit, reach out to us, please. You can find more information about our services at www.jgigliello.com. And don't forget, we always encourage you to take part in the financial planning process to pursue a confident financial future and, in turn, feel optimistic and proud about your accomplishments. If you've diligently saved over the years and have accumulated investment and retirement assets, and you understand that the success of your retirement is too important to be managing yourself, and you value experienced and professional guidance, feel free to give us a call for a complimentary initial consultation. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. If you found this helpful, share this episode, and don't forget to subscribe. If there's a financial planning topic you would like us to address on a future episode of the Retirement Fix, please reach out and let us know. Until next time, thanks for listening and make it a great day. John Gigliello is a registered representative with and securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not intended to provide a specific advice or recommendations for any individual. Albany Financial Group and LPL Financial do not provide tax advice or services. Please consult your tax advisor regarding your specific situation.